Okay, guys, welcome to today's class. So this is basically the day 3 of the deferred tax masterclass, and this is also day 1 of the Saturday 3 classes. So every Saturday, every Saturday from 11 till 12, 12:30 latest, we will do a free class. It will roughly be 10 to 15 minutes recap and then doing a question. But most likely the recap will most likely happen as we do the question. So I will let you know when is the next class. The next class will most likely be next week, but we'll get into that. And so before we start, for those of you who are new, so I'm Faiz Khan. So I run Eduhans, and Edions basically provides online courses for aspiring chartered accountants like yourselves to help you pass with confidence. And it basically we all start basically our main purpose is to help elevate you, is to help transform your understanding. And the way we do that is basically to try and unlock your true potential, and by simplifying difficult concepts and giving you an approach to think. Okay, so that is basically what we do. And and what we will what we're going to be covering is this question. It is it's fact 4863. Can't remember which which test it is, but it's basically in the 2020 fact 4863 test letter. So I really covered quite a few of those questions in the test letter, and I don't make a list of the questions I cover, but I just like read through, and I generally will be able to pick up if it looks familiar. So this question does not look familiar to me. The name doesn't definitely. I don't remember the name of the company, and I just squeezed through the question. I don't remember doing the question, so hopefully it is a brand new question that I haven't covered before. But either way, even if it is not, um, the the good thing of this is not a highly complex question. It is not easy, but it's not complex. And the niceness of it is that when you do a question for the first time, when you tackle a topic for the first time, you must not do a very difficult question. You must do a question that is fairly basic, so that you can learn the principles and spend your time learning the basic principles. Because once the foundations are sorted, and then you move on to a more complex question, then that's a lot better, as opposed to doing a complex question from the very beginning. Okay, so I mean, you can think about it in anything. When if you think about the child, when they start to walk, you don't let them run the first time. They're walking, and they're not even really walking. When you ride a bike, when you learn to ride a bike, you most of us start off first with training wheels. When you learn to swim, you don't swim in the deep end, nor do you swim in the ocean. You start in the shallow areas. So the same thing, if you use just normal principles of life, you can apply it here as well, where you simply start off with basic stuff just to get the fundamentals right. Once you have the fundamentals right, then you need to progress. Obviously, if you want to be a great swimmer and you want to swim in oceans, you're going to have to go practice in the ocean. If you want to be a great runner, you're going to have to practice running. Over here, you chose to do accounting. You chose the path of becoming an accountant or becoming a chartered accountant. Whether you're third year or whether you are CTA, you chose that path. As a result, because you chose that path, you have to do the training. And the training is that, yes, you start off basic if it's something very new to you, but then you have to move over into the more complex scenarios, right? Um, I say this many times. If you watched some of my other videos, I probably said it there as well. So it may seem like I'm repeating myself, but I find it very important. I somewhat, or not somewhat, I do advocate for it, that I advocate for less questions, but higher quality. If you can, do more questions with high quality, then great. But in most cases, we can't do many questions. So I always advocate for a minimum of 3 and then stop at 5. If you're still struggling after 5 questions, then fundamentally there's something wrong. Okay, so when you do a question, you're going to start off with a basic one. This is fairly basic, not super basic, but it's fairly basic. And then we'll move on, and then you can go on into something more higher. But when you practice a question, you basically want to go through, you want to follow some kind of pathway, right? So I generally recommend, I mean, you do what works for you, but I generally recommend like a before process, a during process, and then an after process. So the before process is like 5 minutes. Okay, shouldn't take you more than 5 minutes. And you basically do 3 things. Number 1, you give yourself, so remember this whole process, the whole before process mustn't take more than 5 minutes, is just to get your brain moving, okay? And to get your mind in, to help your mind to focus and to be on alert. So number 1, in no particular order, but basically number 1, give yourself a high level summary of the topic. You know you're going to do deferred tax. So before you do deferred tax, give yourself a high level summary of the important aspects of deferred tax. What are we trying to achieve? How do we do some calculations and so forth? Number 2, if this is not the first question you're doing, you don't do number 2 if it's the very first question, but you do number 2 from question number 2 onwards. So you do point number 2, and that is to remind yourself of the mistakes you made in previous questions and how you corrected it. So you want to remind yourself so you don't make the same mistake again, or mistakes again. The number 3, this is not the objective. Some people can do this from the very beginning. If you're like me, you wouldn't be able to. So I don't do number 3 from the very beginning. I do number 3 I focus on number 3 in question maybe 4 or 5, but I still remind myself about point number 3. What is point number 3? Point number 3 is to tell yourself that you want to work as quickly as possible. So I don't make the first 3 questions. So time in the first 3 questions is not my objective. I don't care whether I finish it within the allocated time, because I'm going to work on that later on. But what I do tell myself is that I want to work as quickly as possible. By me telling that to myself, it's lingering in my brain, and somehow or another, without me really doing much, I'm going to be working as quickly as possible because it's lingering in my mind. But my focus is not to work under time pressure. Okay, so that is the 3 things you do before you start a question, and that is literally that it must take you not more than 5 minutes. Then the during process is doing the question. Okay, doing the question as is, and then you mark yourself. Okay, then you mark yourself. When you mark yourself, this is the important aspect, the marking. So there's 2 things you want to do when you mark yourself. Number 1, you want to identify what you got right. And number 2, you want to identify what you got wrong. For the items you got right, there's just 2 things you need to check. Number 1, did I get it right because I actually knew it, or did I get it right by chance? I took a guess and it came right. If you got it right because you actually knew it, you're happy, you park it. If you got it right by chance, then just try to fix it right there and then. Try to solidify how do you actually get it right. The fact that you got it right by chance mean you kind of know it, but maybe there's just a few things you need to solidify. Do it right there and then, and you know it's done. So that is what you do when you mark yourself for the items you got right. Now, this is where the most of the learning takes place. And I'm telling you, this is where most of the learning will take place. So don't kill yourself when you get something wrong. See it as an opportunity of growth. Remember, it is like a child learning to walk. When they fall 1,000,000 times down, they don't tell themselves, oh, you know what, I'm done learning to walk. They try. like I have 3 small ones over here. 2 of them are walking. Like we need to like lock the cupboards, because they, no matter what you do, they always trying to scratch into the cupboards. So they don't give up, if I can put it that way. Now, similarly with walking, when they're falling down all the time, they don't beat themselves up, they don't give up. So the same thing over here. See this process of what you got wrong as that process of learning how to solidify your understanding of those aspects you got wrong. So for the items you got wrong, there are also 2 questions you need to answer, or not 2 questions you need to answer, but you use these 2 questions to help you gain that understanding. The first question is, where did you go wrong? So that will help you at what point you went wrong. And the second question is, why did you go wrong? So for example, let's say we do a weighted average cost of capital calculation. Now you see your total WACC number is, your WACC percentage is not correct. So now yours is 20%, theirs is 15%. Now you know there's something wrong. Now you need to identify, where did you go wrong? Let's assume you did you identify you went wrong by cost of debt. So now you know where you went wrong, but you need to dig deeper. Where exactly did you go wrong in cost of debt? So what did you pick up? That in cost of debt, you never took tax into account, but the solution did take tax into account. So now you identified where exactly you went wrong. Now the next question is, why did I go wrong over here? Why did I not take tax into account, or why did they? So sometimes it is something fundamentally that you did not understand. Sometimes you actually do know it, you just completely slipped your mind, or you just did a calculation error. Okay, so that will help you to identify, and then you can fix up. So if you did not know you must take tax into account, now you know fundamentally you got something wrong. So now you want to make sure that you understand why tax is taken into account, so that you don't forget it next time. So this process takes a bit of time, and that is why I say 90 minutes, 20 marks, because then you can do this whole process. So under the step number 2, as to where you went wrong and why you went wrong, that is where most of the learning takes place. So that's the during process. Then you can do the after process. Now, the after process is, you can decide if you want to do it or not. I highly recommend that you do it. And there are 2 parts to the after process. Number 1, that is you identify, that is you ask what if scenarios. I don't do this to the nth degree. You do it on the big items, okay? Because I mean, you can do what ifs for a whole question, almost for every single line, but you don't do it for every single line, you do it for the big aspects. So so the what ifs, this plays a big role, because it means you don't need to do 1,000 questions. You can do 3 to 5, and you have covered the entire syllabus. So a typical what if question, you did WACC. For WACC, you need cost of equity. To calculate cost of equity, there are 3 methods. In this question, cost of equity was calculated using CAPM. Now, when you do the what if, you say, what if cost of equity was had to be calculated using the other 2 methods? Now you remind yourself, what are the other 2 methods? Well, the other 2 methods is dividend growth and bond yield. Okay, so now you identified what are the other 2 methods. Then you tell yourself, okay, what are the formulas for dividend growth? What is the formula for bond yield? You tell yourself the formula. Then you say, okay, I got that. But then what would I need in order to, how would I know it is dividend growth? How would I know it is bond yield? What would I need? The fact that you tell yourself the formula, you would know that you would need for the dividend growth, you need dividends, you need growth, and you need share price. And that is basically how you would go through a what if. So you can see a what if can be quite detailed, and that is why you don't do it on everything, but you do it on the big items. Another typical example would be and this is especially for groups, because there's so many variations of groups that you won't be able to do every possible scenario. But that is why if you can think of what ifs, then it can help you. So for another example would be, for what if it is For groups, you had an intercompany transaction. It was sub to parent. Now you say, now you're doing the after process, the what if. So what if it was, what did I just say now? Sub to parent. What if it was parent to sub? Or what if it was parent to associate or associate to parent? So that is what you need to think about. Okay. Similarly, for groups, you want to do this level of thinking as well for the big stuff, right? If the question asked you for journal entries, you must like say, okay, they asked me for journal entries. What if they only asked me for calculations? What if they asked me to discuss this? Can I discuss it? Sometimes we can do calculations, but we can't discuss it. What if they asked me for the financial statements? So remember, the financial statements is fivefold. So included in financial statements there's a list of about 7 to 8 things, but the big 5 is income statement, balance sheet, equity statement, notes to the financial statement, and the cash flow statement. You can ignore cash flow statements for now, because cash flow statements only happen at the end of the year. But you must be able to understand, how does this transaction, even if they only ask you for journal entries, how does this transaction impact balance sheet? How does it impact income statement? How did it look in the notes of the financial statements? For groups, there's not many notes, so you don't have to worry about that now. And then how does impact the equity statement? That is basically what you want to be thinking. So there's no need to do a question on each, because you have thought about it already. Remember, in an exam, they don't set time for you to think. The thinking must have been done during your study period, because the stuff they are giving you is all the same. It is just different scenarios. The moment they give something radically different, that's when they factor in thinking time. So I didn't know about this when I was a student. My accounts 3 lecturer, he explained this to us. When they said the question, and he's part of PSYCA as well. I don't know if he's still, but that time he used to be part of PSYCA, or that, like the exam people that set papers and moderate and all of those type of stuff. So he explained that's how when they set the question, they don't set time, they don't allocate time for thinking. That is why some of us don't finish a question, because we still need to think. The thinking must have been done before the time. It is when something is radically different, then they allocate time for thinking. And that is why when you do this what if, you are actively thinking. So you already seeing all the different types of scenarios in your mind, and when it comes your way, automatically you will already know. When you read a question, when you read this line, for example, particularly for a group question, you want to be able to see the pro forma. You want to be able to see, without doing it, you want to be able to see the pro forma journal entry. You want to be able to see the impact on the balance sheet, the impact on the income statement, the impact on the equity statement. You want to get to that level. How do you get to that level? Is by doing high quality question. When you do a question with a high level of quality. So that is what if step number 1. Number 2, this is if you want to, but number 2 will just take your understanding to a new level, and that and on top of that, it also helps you to it helps you further with step number 1 for the after process. So step number 2 is what I call it a comparison. Do a comparison. So you do this from question 2 onwards. So what is a comparison? A comparison is basically to identify the similarities and to identify the differences. So you identify the similarities between two or more questions. You compare the differences. So for example, let's assume this income tax question is 2020. Now you do an income tax question for 2021, right? Or 2021's income tax question. Now, when you're done with 2020 and 2021, you ask yourself, okay, I did an income tax question of 2020. I did an income tax question of 2021. What is similar between the two questions? What was different? Now, there can be 3 levels over here. Basically, on a high level, there can be 3 levels. Number 1, how they asked the question? How was the required presented? In most cases, there's no difference. Okay, so in most cases, there's no difference between how they asked the required. Sometimes there is a difference. So you want to just quickly have a look. Is there a difference? Did they ask the required differently, or was it the same? Okay. Then the next aspect is, now this can be a little bit tricky, so you don't overly engage in this, but you just do a quick quiz in terms of this. Why this is very useful in WAC, this is somewhat very important of how did they present the question. So I've seen a few questions where people know how to calculate WACC. They can do cost of equity, cost of debt, all of those type of stuff. But just because how the question was presented, they couldn't identify the information. So you want to see, how was the information presented? Similar, different? Did you have to work out a number? Did they give you everything? Things like that. Okay. How did they present? And then where most of the learning will come is the actual answer. Okay, the actual answer. What's the similarities? What are the differences between the actual answers? So the presentation of the question as well as the actual answer solution, that will help you the most in terms of identifying similarities, identifying differences. So this also fits in with a what if. So for example, in question 1, you may have gotten cost of equity using CAPM. Question 2, cost of equity using dividend growth model. What was the similarity? They both needed cost of equity. What was different? The one used CAPM, the one used dividend growth. Then you just so seeing the similarities, seeing the differences will help your brain make the necessary connections. Your job is to help your brain make the connections. The way you're going to make the connections is to not actively think, but is to actively think, if you get what I'm trying to say. You want to tell your brain you are thinking now. So, and you want your brain to, you want to help your brain make that connections. Once you make the connections, it's going to become like hardwire into your brains. So that's why you want to make sure that you have the right thinking process going, so that when it goes from your conscious mind into your subconscious mind, so that when you just look at the question, your brain tells you exactly what needs to be done. You need to help your brain to get to that level, and that is by doing this deep level of learning. And that is why I say 90 minutes a question, 20 to 30 marks, ideally 20-mark question. And you do this process for 90 minutes, and you're doing 90-minute sessions. Don't if you can, but based on psychology, if you work in 90-minute sprints, that is far more productive. So you're working 90-minute sprints, and then you take a 15-minute break, then you go back for another 90 minutes. It is far more productive than sitting for a straight 3 hours. In that 15-minute break, you don't go do something that is going to kill your flow. You do something that is inspiring. You either go sit and think, you just go stand outside, breathe fresh air, or you just sip on some water, you read a random book, a good random book, not the word random, but a good book, just something, but it's not to go use social media now. Okay, so basically that is a process you want to follow. Most of you are full-time working students. You can't do every possible question, so you want to do high quality. Okay, so now we're going to go through this scenario, and we're going to answer the question. We're going to focus on calculating the deferred tax balance, and we're going to focus on calculating the deferred tax movement and how to split the movement between profit and loss and OCI. So that's our focus. If there is time, we're going to, and then I'll give you how to think through setting up the notes. But the objective here is not to do the notes. The reason being is I have a free video that does a detailed class on doing the notes to the notes to income tax, which is the current tax, as well as the what's the other thing now? The tax rate recon. Okay. So it says measure is listed in the industrial sector of the Johannesburg Stock Exchange and has a 28 February 2019 financial year end. The following information relates to Major Ltd for the year ended 28 February 2019. Okay, so this is important. Remember, so if it's for the year ended 28 February 2019, our year starts 1 March 2018 to 28 February 2019. When we're dealing with deferred tax, you want to know the date you are dealing with because the balance need to be at that particular date. So they say the profit before tax for the year before taking into account the information in notes 2 to 4 is as follows. Let me just see my recording. Yes, okay. So we have 21 million and we have 18 million. Number 2, so the depreciation expense of 4 million rand for the 2019 financial year does not include a change in estimate of 560,000 rand, an increase in depreciation arising from a revision of the estimated useful lives of vehicles. The revision of the useful lives was done after the profit before tax in note number 1 was calculated. The carrying amount and tax base of the vehicles before taking into account the change in estimate are as follows. Okay, so here is the tax, the accounting carrying amount and the tax base. Now remember, in 2019, this amount is before the change in estimate. So the fact that it's before the change in estimate, we need to adjust this 22 million. Now, the change in estimate of 560,000 rand was an increase in depreciation. The fact that there's an increase in depreciation, that means is an increase in accumulated depreciation. So an increase in accumulated depreciation will cause a decrease in the accounting carrying amount. So this amount needs to be 22 million minus 560,000 rand. Okay, so just take note. Now, if you just look at it from if you look at this accounting carrying amount versus tax base, okay? Accounting carrying amount versus tax base. So we know, if we, without reading further, let's just apply, let's apply deferred tax definitions, okay? So we know what is deferred tax. Deferred tax, well, loosely speaking, is deferred tax is future tax consequences. So when we set up the table and we have, what is this now? What is this? PPE, whatever it is, okay? So this is depreciation expense include, okay. Okay, so it's vehicles. What's happening? So vehicles. So for vehicles, we have accounting carrying amount 26 million, the tax base of 18 million. So we know there is a temporary difference of 8 million, if I'm calculating correctly. So the question we need to ask ourselves is that 8 million rand temporary difference a taxable temporary difference or a deductible temporary difference? Remember, what makes something a taxable temporary difference? So something will be a taxable temporary difference when future taxable profit will result in a taxable amount. Something will be a deductible temporary difference when the future taxable profit will result in a deductible amount. Okay, so just take note of that. So here we have an 8 million rand temporary difference. The question is that 8 million rand a taxable temporary difference or a deductible temporary difference? So what should go through your head? What should go through your head in really quickly, eh? But remember, for now, we don't worry about time, but you want to get to the point where it goes really quickly through your head. So by virtue of the fact that we have a 26 million rand carrying amount, it implies on the balance, on the statement of financial position, we have vehicles, which is an asset at 26 million rand. So inherent in the asset definition, it implies that this company measure is expecting future economic benefits from these vehicles to an amount of 26 million rand. So we expect 26 million rand of income, right? So the impact on accounting profit, there's going to be an income of 26 million rand. The fact that accounting profit will have a 26 million rand income, tax would also have an income of 26 million rand. But every asset is an expense waiting to happen. Like we said, an asset is a glorified expense. So this 26 million rand will be expensed over its remaining useful life through depreciation. So what is accounting going to depreciate in future over its useful life? A 26 million rand. So accounting have an income of 26 million, an expense of 26 million. So the impact on profit is 0. Over here, tax have the income of 26 million, but the future tax deductions is only going to be 18 million. So therefore, tax is going to have an income of 26 million. It's going to have a wear and tear allowance of 18 million. So tax is going to have a profit of 8 million rand in future. So in future, the net position, accounting profit is 0. The net position, tax profit is 8 million. So in future, taxable profit is more than accounting profit. So therefore, we have a taxable temporary difference, and therefore it is a deferred tax liability, just for that one line item. The same thinking will be applied over here. So that is basically what you want to follow, right? Remember, then you can test yourself to make sure that your thinking is correct. There are like kind of rules you can apply, but you can't use those rules as an explanation, okay? But basically, when the carrying amount of an asset is more than its tax base, then it will be a taxable temporary difference. When the accounting carrying amount of an asset is more than the tax base, then it will result in a taxable temporary difference, which implies it will be a deferred tax liability, okay? But you can't write that as an explanation, okay? That doesn't explain anything. That is just a rule. The rule is in the accounting book as well, okay? So in deferred tax, when they give the definition of, the definition of a tax base for an asset, they'll tell you, the last sentence is that, okay? So just be aware, but that's not the explanation. Okay, so no vehicle was sold or purchased during the year. Okay, cool. Number 3, you guys still here, right? So I see the things disappearing, then it shows up. You guys still here? So to make sure, just say yes, no, thumbs up, whatever. You are still around. Okay.
Yes.
Okay, but I just see the screen every time disappearing. So I just want to make sure. Okay, so number 3, after the profit in note number 1 was calculated, after, okay, so take note, after, the directors decided to change the accounting policy of the company in respect of the valuation of inventories. Previously, the company valued inventories on the weighted average method and changed the policy to the first in, first out method. So it went from WAC to first in to FIFO, since it will result in more relevant and reliable presentation of the effect of inflation on the company's inventory balances. The inventory values at the end of February based on the 2 methods of valuation were as follows. Okay, we're not going to do this, but you can have a look at that. There's the numbers. So they say assume SARS will not reopen the previous year's assessments for the change in the valuation method. Okay, so what does that imply? So if you read section 22 of the Income Tax Act, right? It basically comes down to the fact that inventory, in terms of the Income Tax Act, is valued in the same way as for accounting purposes. Okay, so whatever method you use for accounting purposes, that SARS will accept for tax purposes. Okay, so if you use value FIFO, SARS will be happy. If you use WACC, SARS will be happy. As a result, to a large extent, okay, except for other stuff, to a large extent, the inventory balance on an account, the inventory accounting carrying amount and the inventory tax base will be the same. And since the two amounts are the same, there will be no temporary difference. Okay, so you're happy with that. Now, however, there is a change in there's a change in the method of valuing inventory. So last year we valued inventory using FIFO. Okay, so using WACC. So last year, accounting carrying amount was 1370, tax base was 1370. So there is no temporary difference. Okay, so we're happy with that. Now, this year, 2019, in 2019, the balance for 2019 is now measured using FIFO. So we're using 1490. So the accounting carrying amount for the inventory balance of 2019 is 1490. The inventory balance for tax purposes will also be 1490. So therefore, in 2019, the inventory temporary difference will be 0. So there's no temporary difference. However, with a change in an accounting policy, IAS 8 deals with changes in accounting policies, changes in estimates, and correction of errors. So IAS 8 says that when you have a change in accounting policy, or you have a correction of error, so this applies to both correction of errors and change in accounting policy, but I'm just going to speak for change in accounting policy. When you have a change in accounting policy, then you need to make adjustments retrospectively. Retrospectively means you must go back in time. So we need to go back to previous financial years and go change the inventory balance as if it was always according to FIFO. So in the 2019 financial year, so what's important to take note, let's say this was ShopRite, right? Let's say this was ShopRite. If you must pick up ShopRite's 2018 annual financial statements, you will see inventory of 1370. Okay, so when you pick up the 2018 financial statements, the 2018 financial statements would have a column for 2018 and 2017. 2018 inventory will be 1370. 2017 will be that amount. But now, when you pick up the 2019 financial statements, 2019 will be that, and then 2018 will be that. So in the 2019 financial statements, so in 2019, they will change 2018. Okay, when you pick up the 2018 annual financial statements, you will still see 1370. But when you pick up the 2019 financial statements, the 2019 column will show that. The 2018 column will show that, because in 2019 they're going to change 2018. Okay, and they'll make a note to bring it to your attention that there has been a change in accounting policy, and in 2018 it was 1370 based on the old accounting policy, and now it is 1440. Okay, so in 2019 they will go back and change 2018, 2017, 2016, and all of those stuff. But basically, we'll go back and just change the last 2 years. Okay. So, but we'll only see the change come through in the 2019 financial statements. Now, in 2019, when we do 2018, our balance is going to be 1440. Now, they're telling us that SARS is not reopening previous assessments. So therefore, SARS is still going to see 1370. So in that case, we're going to have We now have a temporary difference. Okay, so important to take note. So the temporary difference would not have existed in the 2018 financial year, but it's going to exist in the 2019 financial year for the 2018 figures. So just take note, when you have a change in accounting policy, you have to adjust retrospectively. Retrospectively means you go back in time. So just be aware of that. Okay, so that is just explaining that aspect. So there will be a deferred tax consequence, but only for the 2018 numbers. And that will be when we do the 2019 calcul, when we in the 2019 financial year. So just take note. So number 4, oh, just by the way, before we miss, if they said SARS does allow you to reopen, then there will be no temporary difference. But they're always going to tell you SARS is not going to reopen. The SARS probably won't reopen, depending on, unless you're a big client. But then also, why they're going to say SARS don't reopen, because they want to see whether you know what needs to be done. Okay. Okay, so Malaysia acquired land for 2 million rand on 10 March 2018. So remember our financial year, 1 March to 28 February. So the land was acquired in the current financial year. So that means there was no land in the prior financial years. Where is this now? The land is measured at the cost model in terms of IAS 16, property, plant, and equipment. It is the policy of the company to subsequently measure land according to the revaluation model. The fair value of the land on 28 February 2019 amounted to 3 million rand. So there's a 1 million rand adjustment. No entry has been recorded to reflect the revaluation. Okay, so when you see that, you must know that what is extremely useful when it comes to accounting, when you read the transaction. So why is it useful? Firstly, it's going to help you to understand different things, but it's also going to help you to see the fuller picture. Okay. So when you read an accounting transaction, even if they don't ask you for it, think about the journal entry. Because if you can see the journal entry makes it easier for you to understand the impact on the financial statements. So remember, the ultimate purpose of financial reporting is to communicate a set of financial information. Okay, and the financial information comes in the form of AFS, in the form of annual financial statements. Thinking in terms of journal entries will help you to understand the impact on journal entries. And I can tell you that this way of thinking gets done in the real world as well. I've worked at 2 companies as a financial accountant. When we look at the impact on the financial statements, we think in terms of the journal entries, like the finance managers. They would think, okay, what is a journal entry? So knowing the journal entry tells us which statements get impacted and how it gets impacted. Even when we discuss stuff with the auditors, we think in terms of journal entries, but it just helps to see the flow of things. And like in one of my most recent positions, when I was a financial accountant, working in a small team, so you work very closely with the finance director. And even he would think, like, I was like quite surprised. Like, I was just look out for these type of stuff. I just find it fascinating, like just to see how finance managers, how directors, CFOs think. And like when he wants to understand the impact on his income statement. So if he's very always trying to understand the impact of the income statement, because remember an impact of the profit is like now. So they always have a look, what is the impact on the profit? They always run through the journal entry. They say, okay, so we're going to process that journal entry because what they're trying to get to, they're not interested in the journal entry. They're just using the entry to understand the impact. And the biggest impact they are looking at, what is the impact on profit? So over here, you want to process the journal entry. So you can see you have a land of 2 million and you have the revaluation amount, the fair value of the land is now 3 million. So the went from 2 million to 3 million. So it's a 1 million rand increase. So what is the impact on the annual financial statements? The impact is land increased by 1 million. So land is an asset, so therefore assets have increased. Assets increase on the debit side. So it's debit land SFP 1 million. For every debit, there has to be a credit. So where does that credit go? So remember, the credit can go in 4 places, okay? Possible 4 places. So the credit can go to an SFP. You can have an asset that created a liability, okay? You can have an asset that reduced, you can have an asset that you created an asset by changing another asset. So you increase land, but then you credit another asset. Okay, so you decrease another asset. So that is the impact on the balance sheet. The balance sheet through this transaction would have been impacted in 2 ways, either converting one asset to another or creating a liability. Okay, so that's the one. The other 3 is the credit of 1 million could either go to profit or loss, or it could go through OCI, or it could go directly through equity. So you'll have to figure out which of those 4 it is. Now we know this relates to revaluation. So revaluation is, and it's IAS 16. So revaluation is dealt with in IAS 16. What does IAS 16 say regarding a revaluation? Where does a revaluation go? So IAS 16 says a revaluation goes through OCI. So the journal entry is debit land SFP 1 million, credit revaluation gain OCI 1 million. So there we can see the impact on the income statement is there's no impact on profit or loss, but there is an impact on other comprehensive income of R1 million. Okay, so that is basically always try to think of the journal entries, and particularly in groups. That's going to help you to understand what needs to actually take place, and also help you to develop a way of thinking so that if you become an accountant or you become an auditor, because remember, an auditor, you want to make sure that things are free from material misstatement. So you want to make sure that things are going to the right places. So the way you identify, without chatting to anyone, just running through your head, or when an accountant, when you chat to the client and they tell you what happened with the transaction, if you run the journal entries through your head and you understand the business, you will see whether it makes sense or not. Okay, so just be aware of that. Tandeka, you have your hand raised.
How do we account for a devaluation and impairment on land?
Okay, so I'll go through it really quickly. But I covered it in the impairment masterclass of last year, where we went through it. But basically, when there's an impairment, so IAS 36 says the following: when there is an impairment, you have to recognize the impairment in profit or loss immediately. But there are a few exceptions. So one of the exceptions is that if there is a revaluation amount, you first, so let's say the revaluation amount here is 1 million rand, right? And the impairment is 2 million rand. You would first take the impairment to OCI as far as that the revaluation amount is, and then the remaining will go through profit or loss. So like I said, the impairment is 2 million. So of the 2 million, say there was no revaluation, the full 2 million goes through profit or loss immediately. But because there is a revaluation, you first reduce the revaluation till it is 0. So we have a 1 million rand, so we reduce it till 0. So what is the remaining of the impairment? There's another 1 million rand. That 1 million rand goes through P&L. Hope that answers your question. Okay. Okay, so we went through that. Okay, so remember the impact over here is a 1 million rand on, there's a 1 million rand gain going through OCI. Now, our asset is 3 million at 28 February 2019. So the accounting carrying amount is 3 million. What is the tax base? Okay, so remember the tax base for SARS will be cost price 2 million. SARS does not care about the revaluations. Okay. So there will be a temporary difference of 1 million rand, and you can run through whether it's a taxable temporary difference or whether it's a deductible temporary difference. You know it should be a taxable temporary difference. Why? Because the accounting carrying amount is more than its tax base. When the accounting carrying amount is more than its tax base, it will be a taxable temporary difference. But you don't want that to be your reasoning. You want to prove it using the methods I showed you above, okay, or in the previous classes. Okay, so included in profit before tax, among others. Remember they said notes 2 to 4 was not included in profit before tax. Here they're telling us this is included in profit before tax. So we have dividends received, 200,000 rand. Okay, so you need to calculate current tax. It is important to identify in current tax the differences between accounting profit and taxable income. Remember, the way you calculate current tax, it is going to be taxable income times the tax rate. The way you calculate current tax, taxable income times the tax rate. So when the way we get to taxable income, we start off with profit before tax. We start off with the accounting profit before tax, and we make adjustments to get to taxable income. Okay, now remember, there are two types of adjustments you make. You make adjustments for permanent differences, and you make adjustments for temporary differences. The temporary differences will come through the deferred tax calculation. So just be aware of that. So here we have dividends received, not taxable. So you know there's a difference between tax and accounting. You need to identify whether it's permanent or whether it is temporary. So this is a permanent difference. Okay. Remember, all permanent differences will filter through the tax rate recon. Foreign income after deduction of 10,000 rand foreign taxes that is not taxable in South Africa. Okay. So there's foreign tax. So here we see included in profit before tax is 50,000 rand. Please take note of this. This 50,000 rand is net of 10,000 rand. I'll explain this just now. And then we have donation, not deductible. So there's a permanent difference over there. Please be aware of this aspect. Very, very important. I'll do the taxable income calculation really quickly just to explain this aspect, because it's very, very important. It comes through very big over here through that line item, but it's something you must just be aware of throughout accounting. Okay, you must just be aware of it throughout accounting. The normal tax rate is 28%. Remember this year, I think on the 1st of April, I think, the tax rate is going to change to 27%. So I want to tell you, for the CTA guys, please make sure you can deal with the change in tax rate for test 1. I don't say it's going to come in, but it's highly likely that's going to come in. Like, so highly likely that I think is 100%. Okay, but I mean, it doesn't have to come in, but highly likely that it will come in. Please make sure you go, when you do an income tax question, make sure you choose an income tax question that deals with a change in tax rate. Okay, you want to know how to deal with it. Donation, 10,000 rand. Normal tax rate 28, capital gains 80%. Tax payable account in the general ledger on 28 February 2019 is as follows. Opening balance, what is this now? Tax payable tax payable. Oh, okay. So opening balance, tax payable in respect of 2018, 5.3. Payment made, payment made in final settlement of 2018 assessment, 5.2. Provisional payments made in respect of 20K, 3.2. And then whatever, there's a balance. Okay, cool, happy. So we're gonna do this part over here. We're gonna do part, we will do this part over here. Okay, we need to do the tax calculation, but I will, I'm just gonna give you the answer. I'll do it quickly. I'm not gonna run through it. You can run through it yourself. But I will, we're gonna do this. So prepare the income tax note. I'm not gonna prepare the note. I'm just going to do the deferred tax balance calculation, and I'll do the current tax income calculation. You can prepare the notes. If you don't know how, you can watch one of my other videos on deferred tax, on income taxes. We done it last year, 2021, in February or in March. So if you just go to the YouTube channel and you go to all videos, then one of the very first videos that we created was on the income, the notes to the income tax. I'm not going to deal with that today. So I'll do with calculating current tax calculation and setting up deferred tax. I just need to take 5 minutes quickly. Well, not, I just need to get a tissue quickly, and then we can continue. In the meantime, while I get the tissue, if you have any questions, you can gather it in your mind if you want to ask it, or you can type it out in the chat. So I'm now back. Do I have a free masterclass dealing with change in tax rates? I don't recall doing a change in tax rates. But you can try. If you have any question, you can just message me. When is land exempt when calculating deferred tax? When is land exempt when calculating deferred tax? Did you come across, I can't think of a scenario. Did you come across a scenario of that nature? Land exempt when calculating deferred tax. I can't think of a scenario. Asanda?
Hi. Just to go into the part about land being exempt when calculating deferred tax, doesn't the standard give you a way to determine in IAS 1215 on when you'll be able to say look exactly at when land is actually exempt when calculating deferred tax using either the balance sheet method or the income statement approach.
So ISTAR Para 15 deals with some exemptions. That is correct. So the exemption would so either deal with a business combination. That's number one. And then the other one is that on initial recognition, there is a temporary difference, and the temporary difference neither impacted accounting profit or taxable profit. So in that case, it can, I can't think of land, I can't think of an example of buildings where there's going to be a temporary difference. So, so for example, in the Income Tax Act, some buildings don't draw any tax deduction. Okay, there are certain buildings that is not granted any tax deduction. So so therefore, on initial recognition, there's no the accounting carrying amount would be whatever the cost price is that they paid for the building, and the tax base. Remember, what is a tax base? A tax base is any future deductions, but there's no future deduction. So then kind of it is zero. So then it gives rise to a temporary difference, if I can put it in inverted commas. But that temporary difference is not is exempt in terms of Para 15 because the temporary difference arose at initial recognition. And when the temporary difference arose at initial recognition, so two criteria must happen. It arose at initial recognition and there was no impact on on accounting profit nor income tax or taxable profit. So if you think about the journal entries, when accounting recognized the building, they said debit building, let's say 15 million Rand, credit bank or trade payables, 15 million Rand. So debiting buildings is an asset, so it's a SFP. Credit bank or trade payables, it's an asset or a liability, so it's a SFP. As you can see, that journal entry has no impact on profit or loss. Okay. For SARS's purpose, they see nothing. Okay, there's absolutely nothing from SARS's purpose. So nothing hits taxable profit as well. So we have a at initial recognition we have a temporary difference on this building. But this temporary difference arose at initial recognition because accounting sees a building, SARS sees nothing, and at initial recognition there was no journal entry going through profit or loss from an accounting perspective. At initial recognition, nothing went through taxable profit because SARS sees nothing. So when you have a situation of this nature, where there's a temporary difference that arose at initial recognition, and it did not impact accounting profit and or taxable profit, then that difference is exempt. So that is an example I can think of. I can't think of the land, but basically that is the Para 15 example, assuming it is not a business combination, assuming just a normal company transaction and not a business. It did not result as part of a business combination. Okay, so I hope that answers the question.
Phase.
Yeah.
So if a question gives you like a group of assets and then they tell you about land, but they don't tell you anything. Basically, they tell you about factory buildings, how they are depreciated and what SARS says. But in terms of land, the question is silent. So is it okay to actually assume then that, okay, land actually meets the criteria of there's an initial recognition of an asset, not in a business combination, and it doesn't affect either accounting profit or taxable profit?
Not necessarily, because SARS is going to tax you when you sell the land. So it is not, SARS sees the cost price of the land. SARS sees debit land 15 million, credit, bank or trade payables, 15 million. SARS don't tax you throughout the use of the land, but SARS is going to tax you when you sell it. So generally, that para 15 is the typical example for that para 15 example is for buildings. Okay. So there's a certain type of admin building that SARS don't grant a deduction for, but accounting always going to put through depreciation and so forth. So there's a certain administrative type of building that SARS do not grant a deduction for.
Okay, thank you.
Okay, so let's go into doing the question. Okay, so they say, please note the movement in temporary difference in the current tax calculation must be calculated using the statement of financial position method. Okay, the tax expense reconciliation should be in accordance with IAS 12, paragraph 81, 1. Okay, comparative figures are not required. So take note, this is of extreme importance. Comparative figures are not required. Remember, we prepare, this is financial reporting. Financial reporting is all about preparing a set of financial statements. Now, I told you, as part of a set of financial statements is those 5 statements. But what is part of a set of financial statements is comparative figures. Comparative figures is either 1 year or 2 years. You can decide, but at least 1 year. Okay, so if they don't tell you to ignore comparative figures, by default, you need to show comparative figures. And that is why they always tell you to ignore comparative figures, because they don't really want comparative figures. But if they don't tell you, you have to show it, because a set of financial statements must include comparative figures. Okay. Okay, so this year, statement of financial position method, remember the income statement method would have been to show depreciation and then to show wear and tear. But if you do that approach, you'll get 0. You must do the statement of financial position approach, where you compare asset to asset. Okay, so just be aware of that. This over here, you have to read your accounting standard to see what is that. And I think 81.1 is, we showed on a numbers level. 81.2 would show it on a percentage level. Okay. So we're going to do the calculations. We're not going to do the actual notes. I will, you can look on the YouTube channel for it. If you can't find it, you can message me. I can try to find it. Okay. But first you try to find it, and then if you can't, you can message me. Okay. So let's go. I'm switching to Excel now. Okay, so we're going to do the deferred tax calculation. So okay, so I'm trying to do. So we're going to do the deferred tax calculation. Okay, so remember, when we do a deferred tax calculation, it's of importance to show the date. So we're going to have to start off with the prior year, 28 February 2018. They never gave us a deferred tax balance of 28 as at 28 February 2018. So therefore, we need to show this balance. We need to do the calculation because we need it for the movement. Okay, then we need 28 February 2019. And we're going to need, yeah, so that's what we're going to do. Okay, so then debit, credit. So I'm going to have assets. Okay, so it's carrying amount, tax base, temporary difference. Let's think quickly. Okay, I just have this column over here, percentage included, 100% or 80%. You don't have to have this. I just do this. Just make my life easier from a calculation point of view. And then we have deferred tax. Okay, at 28%. Okay, so this year, remember my debit is going to be a negative, and then this will be a credit. Okay. Okay, so there we go. So you don't have to have this column. Some people have it in one time over there, but I want to use calculation. I'm using Excel, using a spreadsheet. One of the spreadsheet, what do they call it now? But a spreadsheet, like a rule, I can put it that way. I can't now get to the term they use, but a spreadsheet rule is that you don't want to have hard typed numbers. Okay, so it's very difficult to pick up errors like that. So in order to make sure that I don't have hard typed numbers, I include the extra column to show 100% or 80% so that I can get the correct 28%. If I have it in over here, I'm going to have to manually type in 80% or 100%. I don't want to do that. So that's what I'm just doing. Okay, so that's to avoid spreadsheet errors. Okay, so that is fine. Okay, so now we need to identify the assets and the liabilities. Okay, so we need to identify the assets and the liabilities. So in terms of the question, we go from 2 to 4. From 2 to 4, in terms of the question, we're going to have vehicles. Okay, so we're going to have vehicles. So we have vehicles. We're going to have inventory, and then we're going to have land. Okay, so we're going to have inventory, then we're going to have land. Okay, so I think that is about it. Let's see if I didn't miss anything else. Okay, so that should be about it. Okay, so I always just list all my assets. I just list all my assets, all my liabilities. I'm going to get a total over here. I'll just get a total. Okay. Okay. Then we're going to have total movement. Okay, so then we'll have total movement, and then we're going to say movement made up as. Okay, so that's just kind of how we just split it out. Remember, the movement can go through 3 places. The movement can go through 3 places. So OCI, directly through equity, and then profit or loss. Okay. So just take note of that. So that is basically how it would be made up. Yes, Dandeka, I see your hand is up.
Please, can you add a liability? I know it's not part of the question, but
Okay, so let's just finish the question and then we will go through the liability aspect, okay?
Thank you, sir.
Okay. Okay, so that is what we will do. So we'll made up as that. Remember, a movement goes through profit or loss. So remember, deferred tax follows the underlying transaction. Deferred tax is consistent with the underlying transaction. Or rather, let me put it this way, the accounting for deferred tax is consistent with the accounting for the underlying transaction. So if the underlying transaction goes through profit or loss, deferred tax goes through profit or loss. If the underlying transaction goes through OCI, the underlying transaction goes through OCI, deferred tax goes through OCI. If the underlying transaction goes directly through equity, then the deferred tax goes directly through equity. So deferred tax follows the underlying transaction. Very important. That is a principle in terms of IAS 30, in terms of IAS 12. Okay. So now let's have a look at the vehicles. So the vehicles is, where is this now? Okay. So the vehicles is, okay, so the vehicles is 26 million and 18 million. Okay, so 26 million carrying amount and 18 million carrying tax base. Okay, what's happening over here? Okay, what's happening over there? But anyway, so 18 million. Temporary difference would be 26 minus 18. Percentage included 100%. So therefore, deferred tax is going to be 8 million times 100% times 28%. Okay. Okay, so there we go. Inventory, last year inventory was, you don't have to show inventory, but I'm just doing it. So inventory was, inventory this year. So remember, it's important to take note. So we're doing this calculations at 28 February 2019. But remember, when are we doing this calculations? So this deferred tax calculation is being performed in the 2019 financial year. Okay, so it's very important when we're doing this calculation. So we're doing this calculation in the 2019 financial year. So remember, inventory the change in accounting policy took place in the 2019 financial year. With the change in accounting policy, there is a we adjust retrospectively. We need to go back in time. So going back in time, inventory is now, where is that now? Going back in time, inventory is now 1440. Okay, so inventory is now 1440. From an accounting perspective, inventory is 1440, 123. From a tax point of view, the SARS is not reopening 2018, so it will remain at the same amount of, I think, 1370. Just check. 1370. Okay, so just be aware of that. So if I just drag this down, there will be a temporary difference. This will also be 100%. So the formula would apply. Okay, land, we only acquired land in the 2019 financial year, so there's nothing and nothing. Okay. Now for vehicles, the tax base for vehicles is, let me just get this. So remember, we went through the reasoning already. So this is going to be a deferred tax liability. There's going to be a deferred tax liability. The accounting carrying amount exceeds the tax base, so that will end up being a deferred tax liability because it's a taxable temporary difference. You want to be able to explain to yourself why it is a taxable temporary difference. Okay, so I already took you through the explanation. Okay, so the balance over here would be that sum. Okay. Okay. Now we will do, now we're going to deal with the, now we're going to deal with 2019. So in 2019, inventory is 1490600, 1490600. So inventory 1490600, 1490600. So remember, from a SARS point of view, they agree with every with how accounting treats something. So we're happy with that. So they agree with how accounting treats something, so therefore will be the same. There's only a difference over here because the change happened in the current financial year. SARS is not going back to change their previous years. Okay, so just be aware of that. So therefore there will be nothing over here. If there was something, we would include it at 100%. For land is now sitting at 3,123,000. From a SARS point of view, it's sitting at 2,123,000. So there we have a R1,000,000 temporary difference. Now, what you must know, the way you measure a deferred tax is based on two things. The way you measure a deferred tax is based on two things. One, how are you going to recover that asset or liability? How are you going to recover the asset or settle the liability? And then number two, the rate of tax. For our purposes, the rate of tax is 28%, right? How are we going to recover the asset is through sale. So when we recover the asset through sale, we have to apply the CGT rate. The CGT rate is at 80% of the 28% amount, right? So therefore, with the CGT rate, we only include 80%, and we will still apply 28% on that. So just take note. So for the CGT, the inclusion rate is only 80% because we're going to recover the asset through sale. The full temporary difference is going to be recovered through sale. As a result, the full temporary difference will be at the CGT rate. So that is going to be our deferred tax balance. Okay. Now for vehicles. For vehicles, where's vehicles now? So remember, vehicles is 22 million and 12 million. 22 million and 12 million. So the tax base is 12 million. So for vehicles, remember, it is 22 million. 1, 2, 3, 1, 2, 3. But there was an additional change in estimate that increased depreciation, which means increases accumulated depreciation, and increase in accumulated depreciation decreases the carrying amount. So 560, 1, 2, 3. Okay, so that would be it over there. The rate over here will be 100%. So that would be our deferred tax. Okay, so the movement in deferred tax. So the movement in deferred tax would be as follows. That minus that. So all of these are assets. All of the assets, all of the accounting carrying amounts for the assets exceed the tax base. So therefore, it will be deferred tax liabilities. Remember, you want to be able to explain why it makes sense. Okay, so the total movement is 607 from 268 to 268, 286. From 225 to 268. Okay, so there's a movement of 607, 600. Now, the question is, where does the movement go through? It could either go through OCI, directly through equity, or through profit or loss. So how do we decide? It depends how the where the underlying transaction have gone through. So over here for vehicles and for inventory, the underlying transactions will go through profit or loss. Okay, so therefore, that temporary differences will, the temporary differences over here will go through profit or loss. The only one that will be different is land. Land, the full temporary difference relates to a revaluation. The revaluation goes through OCI. As a result, the deferred tax will go through OCI. Okay, so as a result, the deferred tax will go through OCI. So what's important to take note is that over here, of the 607, 224 will go through 224 will go through 224 will go through OCI. Nothing will go directly through equity. There's no transaction that is going directly through equity. So the difference will then go through profit or loss. So that minus that will go through profit or loss. Okay, so what goes through profit or loss is the 383,600. What goes through OCI is the 224. What's important to take note is the following. The full movement is 607. So the full movement is 607. But all this movement, we need to see where it goes through. Not everything is going through profit or loss. Not everything is going through profit or loss. It can either go through profit or loss or OCI or directly through equity. How do we know where it goes through? It's based on the underlying transaction. All of them goes through profit or loss other than land, because land relates to a revaluation. Land is PPE, a revaluation on PPE, according to IAS 16, goes through OCI. So therefore, the deferred tax on the revaluation on land goes through OCI. Everything else goes through P&L. Okay, Katinda. Can I ask you a question? Yeah.
Yeah. Okay. So I this is what I do understand. And saying that land for land, right? The minute that you revalue an asset, we are saying to the taxman that the impression is that you have changed your intentions and the manner of recovery. We are saying instead of through usage, it's now sell. When you revalue, the taxman is now saying your intentions could be to sell this land. That's the reason why we apply CGT principles on land, right? But I've seen some certain scenarios where you have both something being treated at the normal deferred tax rate, and also it feeds into the CGT rate. What gives rise to those situations?
Okay, so we're not changing our intention. Okay, land can only be recovered through sale. Land can't be recovered through use. That is why we don't depreciate land. Okay, so we're not changing our intention. So when you measure deferred tax, okay, deferred tax is measured based on the tax rate. Now the tax rate can be either twofold. For our purposes, for South African tax law, there's two ways. There's two rates we can be taxed on: the revenue rate or the capital rate. Okay, so when it's considered to be a revenue asset, SARS is going to tax you using the 28%. When it's considered to be a capital asset, SARS is going to charge you, SARS is going to tax you based on the CGT rate. Okay. Now, the question you spoke about is now hardly tested because that accounting treatment is no longer tested in terms of SICA. Okay, but let's give a quick example as to explain how this happens. Okay, so this happens when you have a asset like vehicles that is a depreciable asset, and then you also apply the revaluation model to a depreciable asset. Now that accounting treatment is still in IAS 16, but SICA don't test it anymore. It's not part of the SICA syllabus. The reason being is SICA want to test us on things that is relevant to the real world. Most companies don't do revaluation on depreciable assets because it takes a lot of time. So I only come to learn this when I was a financial accountant. They make decisions, too much effort. No, we're not going to do it. Okay. So if the benefit does not exceed the cost doesn't mean money, but time and all of those type of stuff, they don't bother. So most companies don't bother with revaluation on depreciable assets. Waste of time, too much stuff to keep track of, just complicate accounting treatments. So, and it doesn't mean much. So because most companies don't do it, SARS, SICA don't test it anymore. But basically, this is what it basically deals with. Let's look at it from a tax point of view. Okay, when you work out capital gains, right? When you sell equipment, so let's say you're selling equipment. When you sell equipment, equipment is considered a capital asset. Okay, so when you sell a capital asset, it attracts CGT. When it attracts CGT, you need to do a CGT calculation. The CGT calculation is calculated as follows. Proceeds less tax value. Okay, so proceeds less tax value. But proceeds, you must proceeds less recoupment, less tax value. So what does SARS do, right? SARS only taxes you the CGT rate on the amount that exceeds the cost price. So if the cost price is 1 million, if the cost price, what did I just do here? Let's use this example. If the cost price is 2 million, 1, 2, 3, and now you are selling it for 3 million, you are making a profit of R1 million. Now, this equipment is a capital asset. So any amount that exceeds the cost price will attract CGT. Okay, so will attract CGT. So 3 million is more than the cost price of 2 million. As a result, it attracts CGT at the CGT rate. So that's where the 1 million rand comes in. Okay. Now, over and above that, if this was a depreciable asset, the cost price would be 2 million, but SARS would have granted you a deduction. When you have a depreciable asset, SARS grants you a deduction, which SARS is saying, as you use the asset over time, the asset is going to lose its value. SARS want to encourage you to buy assets so you can run a business, so you can stimulate the economy. That's why SARS grants deductions on equipment and so forth. It's going to stimulate the economy. Without the equipment, you can't sell, right? You can't produce what you need to produce, so you won't be able to sell. So SARS says, okay, it expects the asset to lose value over time, so it gives you a deduction. SARS didn't expect it to increase in value. So now the tax value, let's say, happened to be 1.5 million. The cost price was 2 million. How did it get to 1.5 million for the tax value? Tax value is cost minus all allowances. Okay, that 500, the 2 million to 1.5 meant SARS granted you a 500,000 rand tax allowance over time up until this point. Now that you're selling the asset, the fact that you're making a lot of money from it, you're making more than it costs. SARS only gave you a deduction because SARS expected the asset to lose value. So now it didn't lose value. So SARS says, okay, please give me back my allowance. So SARS can ask you for an allowance back of 500, which we call recoupment. SARS can recoup back that amount. Now, recoupment allowance was taxed at 28%. So the recoupment is going to be taxed at 28%, the revenue rate. That's 1 million rand over here. The 1 million rand adjustment over here is, what is this, 1 million? Is a capital gain. Capital asset, and any amount above the cost for capital asset is considered a capital gain. So this is going to be at 28% times 80%. So that is what you are talking about. So when you have a depreciable asset that is sold for more than the cost price, there will be two aspects. One, the amount that the selling price, the amount that exceeds the cost price will be taxed at the CGT rate. Because it's a capital asset, it will attract capital gains. Then the amount that is less than the cost price, so the tax value, the difference between the cost price and the tax value, that will be a recoupment for SARS's point of view. And SARS taxes a recoupment at 28%. Why? Because the allowance was granted at 28%. So I hope that explains it. Yeah, so that's it from my side. So that's all from my side. Is there any other question before I deal with that liability question that Andeka had? We are 50 minutes above time, so I want to stop now. Any questions on your guys' side? Anybody? Yes, no? You're going to say no in the chat, so I need to make sure that you are there still.
Please unpack the accounting treatment for the assessed loss.
That's going to take some time. I'll record a video on that and I'll share it. I can't do it now. I have another point right now. Okay, I'll have to do a, what you call it. That's going to take some time. Any other questions? No other questions. Tandeka, what was the question on liability? So I just want to make sure, because then I can just explain it in that assess loss question that I will record next week. and then I can explain it in over there. It's just basically to take you through the thought process of a liability type question. Because then I'll just look for a question that have a liability, then I can explain it in that video. And I don't do it now. I just want to make sure.
Yes, just an accounting treatment for liability, like your provision, your payables.
Okay, so I'll then just bring that through I'll do a pre-recorded video and I'll share it with you guys next week sometime. Okay.
Thank you so much.
Okay, guys, any other questions? No. Change in tax recon. I'm not going to do tax recon. There is a video on that. The video there's a few videos on that. So I'm not going to do. I'll do a change in tax rate. That's fine.
When is the next class?
So the next, you reminded me now. So the next class will most likely be next week. I just need to check my calendar. Same time. So you can just let me know you can just let me know before you leave now, what topic would you like to cover? And I will see from the common ones what topic is. So you can just type in so long while I just check the chat for some questions here. So a direct through equity. So direct through equity, there are two. So an example would be when there's a change in the opening and retained earnings. When there's a change in opening and retained earnings that has a tax implication, then there will be deferred tax that will go directly through equity. The retained earnings is an equity balance. And another example would be when we have that's one example. Trying to think now. Yeah, Connor, there's another example, but that's a typical example. When there's a change opening, when there's an impact on opening and retained earnings, that's a typical example. I sent it via email. Can I get more suggestions quickly before we go? Just type in the chat like suggestions of what you like to cover. Didn't you get the email on because in the email is the download to the question. IFRS 5. Okay, let me put it this way. Based on current test 1 level topics, okay? So this is all, okay.
Can we do IFRS 13?
IFRS 13, yeah, but like, that's a small thing. Okay, but I'll look into IFRS 13. That's fair value.
Okay. Yeah.
Change in accounting policies. Okay, changing degree of control. That is a test 2 type question or test 3. There's a test 3 question. Okay, so I see a lot of people want to change in accounting policy. Okay, so I'll see, look like everybody wants a change in estimate, change in accounting policy thing. Okay, so you guys don't like IAS 8. Okay. Okay, so I think we'll do an IAS 8 type question. Okay. Okay. We can take fair value in the next class. Should have time. Okay. Okay, so I think next week we'll do a change in estimate type question. I mean IAS 8 type question. Okay, guys. That's all from my side. I will see you in the next level. The next level will most likely be Saturday. But I'll let you guys know. I just need to check my calendar. I never checked my calendar yet. So yeah. Cool. So the next class, most likely next week, will be on will be IAS 8. Okay. If you received the email, then at the bottom of the email will be a button to say download. If you didn't receive the email, that means I don't have your email address. Well, actually, some people's email address didn't work because they gave me the wrong email address. So you'd have to resend me your email address. So there were 7 people. So all the email addresses that I got, when I put it up onto my system, 7 people did not, 7 email addresses did not qualify, like, that way for the system. The system kicked it out because it wasn't in whatever, there was some wrong stuff, so it just kicks it out. Okay, so if you didn't get the email address, email means I don't have your email. Okay guys, so I will see you guys next week most likely. Bye-bye.
Thank you, Faiz.
Okay, pleasure. Bye-bye.
Thank you, Faiz.
Pleasure. Bye-bye.
Bye.